with these plastic triangles I had, I would take a 45-degree triangle and lay it against this angle I drew with a trend line. And then I would take a trend line and just draw it along the plastic triangle I held over my computer screen. And that would give me a perfect offset 45-degree angle. And then I could offset a 60-degree angle, or from the 45 here, I could offset another 45-degree angle. The strongest angle of all, by the way, is the 90-degree quadrant. So from any major axis, low to high or high to low, the 90-degree will always give you your very, very long-term bull market definition line. When that 90-degree is ultimately broken, you are no longer in any kind of an uptrend and the whole thing will collapse. But in the meantime, they can bounce around these offset angles and you can get a correction here. And as we saw before with angles, when properly drawn, you can draw a horizontal here to this angle. We should get our high. Then we should go down into a bear market low. In this case, though, these are just offset angles, so it's not exactly the same as a 2x1 and 1x1 pattern. But when it intersects this angle here, we have a reversal too. So it can give you some time objectives also. Square roots also give us major support and resistance, in that if you had a $100 stock, the full square root is 10. So you could find support at 100 minus 10. On the S&P, we find at the 1200 level or thereabouts, the square root of 1200 is basically 34.5, or if we had 1296 was a recent top a year ago, that was the square of 36. So we would find that the S&P often has big corrections that run 34, 35, 36 points, and that would be one square root off the top. We can also take smaller divisions, and we can take a square root of our price and increment it. So the square root of 100 plus 1/8 re-squared is 102.52. If we did the square root of 100 plus 25 cents and re-square it, we get 105. And we can keep re-squaring these levels, and we will find that most of these will come out. Sometimes if we want to take a square root and it's too big, like $10 from 100, we can take the square root of a square root. So the square root of 100 is 10, but the square root of the square root is about 3.1 something. So we would subtract that and we get a price of about 96.84. Most of the square roots, the square root increments, and the square root of the square roots come out all the time in the market. Back when I was trading an S&P hedge fund, what I would frequently do every day is use these square roots by just taking the low of the day. And once I had that, I would take the square root and increment it by a 16th, let's say, and re-square it, and that would give me the first target of the day. And if I re-squared that again with an 1/8 increment, it would give me the next one. So what we could do, what I mean by this is we'll just take a little calculator here. And if the low was 950, we just put 900.5, and we can take the square root of that is 30 something, and we would add a 16th, which is a 0.0625, and we add that, and now what we do is we re-square that again. So we multiply that times that, and then we get 904.25. And you note in here, when I did these resistance levels, I usually started with the extreme low of the day, and what would happen is you would take this level, this would be the 1/16th increment, and notice I have little circles here. There's a rule that as much as they go up, they must go down or consolidate. So if you drew a straight up line circle, they would have to consolidate or go down into a low over here. And from the next level, they would have to go down into a low over here, and they're now on the next level of resistance. If they were over here, they would have to go down into a low right over in here someplace, right over on this level too. So it's just a question. You could also take a little computer program and do the square root of this, and say for x equal to the square root of this raised to a 16th a number of times, it will automatically give you these levels. Again, it's a very simple process here with a calculator. If we took our low of 900.50 and we just take a square root, and now we want to add to that, let's say 1/4, which is 0.25 equals, so now we want to re-square that times itself, and that gives us our 915.56, being the square root of the low plus 1/4. And we can see that these resistance levels work fairly well. And for years and years, I did this until I discovered a much better thing, and this was called the Jenkins natural ratios. I found out that every stock or commodity spins out a very specific and unique support and resistance ratio based on its very first impulse wave up or down from the origin. And this ratio was found by just dividing the first high by the origin price if you're in an uptrend, or if you're in a downtrend, you divide the first low by the top in a downtrend. And these ratios you get are permanent constants for the life of the swing, and that could be for years and years and years. So for example, I have here, if the low was 40 and the first high was 43, then the ratio would be 43 divided by 40, or 1.075, and this would be a constant forever. You would save this number. If it exceeded the 43 top, you would now multiply that top times this ratio, and it would give you the next top. And if that next top was exceeded, you multiply that times the same constant ratio, and it would give you the next one, etc., all the way on up. Here's a quick example of it on a 15-minute Dow Jones chart. After this first 15 minutes or so is in, and you're down in this area, you would take this price high, divide it by the price low, keep that constant, multiply it by this level, and you would get this level. Then you take that same constant here, multiply it times this level, and you'll get this level. Multiply it times the same constant, you get this level. And we see how precise these are. So much so that in the heat of the rally here, all you need to do is know where your lines are, and you can sell or buy accordingly as soon as they touch it, because they always respect it. Sometimes they'll pull down like this and get to the midpoint between the two levels. Sometimes they'll barely come down again, and that's a warning that as they cross it, they're probably going to go to the next level up. So these natural ratio lines are very important. Here's another way mathematically of seeing what they are. The first impulse wave down was 1547 was the price. So we divide 1547 by our top, which is like 1575. And you're going to get some kind of ratio like 0.93 or something, because you're declining, dividing a smaller number by a larger number. Then you keep that ratio, multiply it times this price, and it gives you the next level. Multiply the same constant by this level and get the next one and the next one, and you keep doing this. And we see as they break down, they may hesitate or they may blow right on through, but these give you exact levels. And the most important thing in trading is entering or exiting a trade at the right price. If you can enter near this number that you've calculated right from this origin, you have all these numbers calculated. If you are waiting for them when they come here with the stop just below there, you can make a pretty good rally up into here. And notice some of these points, we're talking 20 S&P, 20, 30, 40 S&P points sometimes on these moves. And so, again, getting the right support and resistance numbers is all important. Now, in theory, what you want is a time and a price equivalent. So if the price impulse wave was the vertical distance, you would like to be able to take this and flip it around sideways to get a time cycle distance. And since each of these are contracting, getting smaller and smaller, one way of doing that is to draw a 45-degree angle. Now, this 45 is not an adjusted one. It is a pure 45 angle, because what we want to do is we just want to take this segment here and divide it into a square. So at this point, imagine there's a square. And what we've done now is we've taken this vertical distance and flipped it horizontally. So this is the time cycle amount coming out where that arrow is. And then as it comes down, now we have a bigger square, a square that's this wide and this wide over here. So now it's a much bigger time square. That comes out right over here. And then there's another level down, which is a bigger square over here, and that comes out right here. Sometimes we have much easier trades. It's both on the angle, which indicates a time cycle, and it's on the price. So we have to go long there with the stop just under that. And then it usually goes to our next target up. So we can use this 45 to give us several time cycle turns to be aware of also. Here again, as we mentioned earlier, you want to keep your perspective. The perspective here is on a weekly chart. If we take our first little rally in the bear market, in the bull market, out of a bear market, we take our first little top on a weekly basis and get the ratio, multiply it times the first top, we will get the secondary top. We multiply this same ratio by the secondary top, we will get the next top. We multiply the same ratio by that, we will get the next. And we can see on a weekly chart, it gives us very good numbers. And we can also use some just straight line offset angles. A 60-degree offset here kind of times where it hits the support. I've got another little 60-degree offset angle here, kind of times where it tops out and goes down to the midpoint between these two levels. Then a 45-degree goes up to the top, intersects. Then it goes down with a 45 offset, hits the low. So we can find out that not only do the natural ratio lines give us good indications of where our major swings are going to occur, but we can also use some offset angles to kind of forecast where they intersect these points. That might be where our big pivot turns are going to come from. These ratio lines work on any scale, 1 minute charts, even 5 minutes. This first little wiggle up to this top on a 5-minute basis, you take that price, divide by the low, get your ratio, then multiply it again. Now sometimes that's too big a ratio and you want smaller gradations. So what I do then is I take the square root of the ratio. So let's say if this ratio was 1.05, I could take a square root of 1.05 and get something that's like 1.024 or 2.5. It's not really a half of the 105. It's the square root of the 105. And then multiply that, and that's what I've done here. Here's the square root, here's the next square root ratio up, the next one. And we can see that even here from this first little wiggle, we're starting to get some nice little impulse waves. It hesitates here, it blows through, there's a gap. Goes right to that one, pulls back to this one, goes up to that one, runs out of steam here, kind of dies on the vine, plunges down, even at the top here. One thing to note is when we get up here and we see there is a loss of momentum, and it is on one of the exact calculated lines, and you have a simple trend line or something going up here. When that trend line is broken and it intersects right at the calculated line, it is usually a pretty good sale. So we get a lot more information of using these natural ratio lines. We can also, if we don't have anything else, or right at the low day, if we want to find out what the prices should be and we don't have to wait for that first leg up to find out, we can use a theoretical natural ratio line. Theoretical based on the past bear market swing. So we take the bear market high on the S&P here, it was 1576. And the final low, or what we assume in the first early days is going to be the final low, we take that ratio, which is 2.36, and to get it down to a smaller working number, you will note that most of the time the movements on the market is 2 to 3%, maybe 5%. So we want to get something down in that range. So we take the square root of this ratio, then the square root of that, the square root of that, the square root of that, until we get a ratio that's within our normal expectations. In this case, about 5% moves. Now, I'll keep this for the life of the bull market. All we have to do now is take this ratio times the low, and that's what it is. You can just take a computer and say for x equals 1 to 20, multiply 666 times this ratio raised to the x power. And that's what these levels are. And we can see that they do bounce around pretty closely to where these highs and lows are. And the big final highs and lows usually will be at these levels. So this is another way of getting nice increments. One of the early slides I showed you was that the slope of the low to the high was the same. And we moved these slopes over to make parallel lines. But what I didn't show you then that we can show now is after we had that first little top, we can project our next top.